Hey guys, this is Brandan Hines with 123 Home Loan. I'm here with Iggy the Realtor from Summit Ridge Group, and we're going to have a little discussion about the 2-1 buy down. So, Iggy's been putting a lot of information about the 2-1 buy down, and I felt it was in all of our best interest to just have a conversation about it because there's definitely some positives and some potential negatives with this loan. So, Iggy, what are your thoughts on the 2-1 buy down?
I think it's a product that exists. I think there's definitely the video I posted like a couple weeks ago maybe came off a little harsh. I did kind of try to preface it by saying there's a use for every type of product, and I think with 2-1 buy downs there's definitely a time and a place for it, specific to like, maybe people are getting some kind of a raise in the near future or getting some kind of like a settlement or maybe they're something good in the future that's guaranteed is coming their way, and maybe they can use the short-term discount for some, I don't know, for something. The rest of my opinion on the 2-1s is that people are gambling for a better tomorrow, and that's the part that kind of worries me.
Yeah, and I think that's a valid point. But I also think that one of the points you brought up was originators are out there selling this as, oh, you can get a temporary payment that's 2% below and you can afford this house. Well, that's selling something that, in my opinion, is negative because you're promising this person they're going to get used to the payment. And then even if it goes up in the second year, maybe this loan originator hasn't educated them enough to help them understand that, no, you still have to qualify off of the full rate payment. So you have to show them that, but psychologically they may be like, oh, well, this is going to be my payment forever, and it's not. And if you're trying to squeeze them into a house on a payment, that's not the way.
It's
you
just
should
bad
do
business in general, 2-1 or not 2-1.
Yeah.
I guess I brought up before the camera turned on. I brought up the example of like adjustable mortgages back in like 06, 07, and I do understand like that. We're not talking apples to apples here. Like, with these 2-1s, you know what your end result's going to be. It's not like it's not an open-ended concept where your interest rate can go to anything. Like,
right.
It's capped. Whereas during the last crisis, like people are getting, like you said, like double their payment, triple
right.
their payment because they didn't understand the type of mortgages they got into or whatever. But I do think like with these 2-1 specifically, like if we do push a high volume of these out, I don't think that it takes a high proportion of those borrowers to fail on their loans to negatively impact our market.
Right.
10% would be enough.
Sure.
And because like what was the default rate on like 07, 08? I mean, it was
massive.
It was massive, but if you look at like percentages, what like percentage of mortgages actually failed, like it was, I think in like the Southeast and states like Alabama, Mississippi and stuff, they just broke like 10 or 11%, and in states like Colorado, I think we're at like 5 or 6. So in the grand scheme of things, like it doesn't take a third of the borrowers to fail to cause
right.
a problem. It takes like a 20th, maybe a 12th or something like that. It's a small fraction that
right.
impacts the market negatively. So, and basically like what we were talking about earlier, man, is like the 2-1 is a tool. 3-2-1 whatever, like I mean they're all tools that have a place, just like interest only loans have a place, just like adjustable rate mortgages have a place. I mean, there's a time and place for all those things. But I think like specifically with lenders that are tied to builders is where I see it the most. I mean, I think they might have invented the phrase marry the house, date the rate, like because
right.
and that's cute and it's fun and games and all that, but like basically you're relying on the fact that interest rates will go down, which in my personal opinion I do think they will go down, and then at some point they'll go up again. I mean, things cycle, you know what I mean? But like I think it's important to remember why interest rates go down, and interest rates generally go down to stimulate the economy out of a bad place, which means that relying on interest rates to go down while relying on property values to go up at the same time, that's a risk I wouldn't be willing to take in the short term. You know what I mean?
Yeah, I do know what you mean, and I agree. A positive result, I shared this with you before we went on camera. 2-1 buy down, seller had a contract fallout. They needed to move this house right away. They wanted it closed in 15 days. So we went to the seller and said, look, if you pay for this 2-1 buy down, buyer can more than qualify on the full payment, but they wanted to have a low payment the first year because they wanted to put a little bit of money into the house, and the second year, and then take on that third year payment and have no problem. Mm-hmm. Now we were able to buy down the rate a little bit more on the permanent financing side of the rate, and got them a rate that they won't likely have to refinance out of, so they won't incur that cost. So, that all makes sense in that situation. So using it as a tool to help the seller, it was a win-win on both sides. So I think that's what, at least in my head, the 2-1 buy down is to bring buyers and sellers together. Sure. And come up with a solution. But again, I highly disagree with going out and selling the initial payment as a motivator to get someone to buy a house. That's just not the way it should work.
I mean, as a culture, man, I think we're all kind of like accustomed to instant gratification, kind of, new car, new house, new phone, who this kind of deal. Like, yeah. I think it's a mistake to think of real estate as a short-term investment, and I'm gonna kind of blame one of my favorite companies, Zillow, for turning real estate into almost like a ticker, where you can go online every month and see like, what's my home value now? What's it now? And people are like sitting at bars, talking about what their homes are worth because there's an algorithm spitting out a number. I think that in the recent few years, in the last 5 or 6 years, I think that's really kind of changed people's mentality about what real estate really means. Like, it's not, I can't tell you how many, I'll tell you a true story, man. Last year I went to what should have been a listing appointment, but it was just a really hard conversation with a borrower who bought a house and within 4 months was in foreclosure. Down in Lorson Ranch, kid knows he's getting deployed, active duty infantry guy, knows at the time of signing the real estate contract to buy a new house, knows that he's being deployed in 8 months. And I wasn't like trying to be heartless, but I asked him very bluntly, I'm like, dude, why did you buy a house if you know you're going to be out of here in 8 months? I mean, like, that's exactly what like roommates are for and apartments are for. Like, there's a reason that rental units exist. It's to not enter a long-term commitment like real estate should be. And his answer was basically, yeah, my realtor told me, dude, that I'm going to walk away with 30-40 grand just like all my friends did. And that's true until it isn't.
Yeah, I mean, definitely, if a realtor is speculating for a customer or a buyer, that is not a good position to put somebody in.
And that doesn't really have anything to do with the 2-1 buy downs, but I mean, I think that has to do with the mentality of like, and I'm kind of a pessimist. You can see it online. Like, I like to prepare for the worst and enjoy the best. You know what I'm saying? Like, I know that at some point, like, the tomorrow is not going to be as good as today at some point. And that's just the mentality I choose to live with. But I feel like by approaching things that way, at least you're ready for the worst case scenario. And I think that a lot of people with like these 2-1s and like banking on a refi later, like a lot of things have to go right for a refi later. Mm-hmm. You know what I'm saying? Like your home value has to be there. The rates fluctuate, multiple times a day. We all know that. Like, the rates change constantly, but like, are you able to capitalize on those rates when it makes sense to do so, in the sense of like, do you still have the income to qualify? Is your home value there to qualify? Has anything happened to your credit in the meantime? So it's like, to what you're talking about, the originators that are pushing these buy downs, like you have a guarantee of some sort to refinance in a couple of years. I think that's really risky and misleading, because it doesn't take much, man. It takes a car accident to ruin your credit. I do think it's dangerous to rely on a better situation 2 years from now. I think you have to go into real estate knowing that what you're getting into today could very well be as good as it gets for a long time.
Sure.
And I just think that's a really responsible way to look at long-term investing.
That's great. So, just to summarize, the 2-1 buy down as a tool. Rates are improving every day. For now. Dramatically for now.
Right.
I mean,
who knows?
They fluctuate, but I think we're seeing it stabilize. So those are good things. And then again, the 2-1 buy down is a tool. So I definitely appreciate you coming in here and just chatting about your thoughts with it. Iggy the Realtor with Summit Ridge Group. Appreciate it, man. Thank you so much.
Thank you, dude.
All right.